Well, you're tuned into IPO Corner. I'm your host, Nickey, and with me is my colleague N. Mahalakshmi. We're going to be talking about TVS Supply Chain Solution IPO, which has come up with an IPO hitting the primary market's initial size of around 880 odd crore, divided in two parts. Fresh issue 600 crore, OFS 280 crore, opens for subscription August 10 and closes August 14. But we have enough and more in terms of the outlook. We've been joined by the management, Ravi Viswanathan, who's the managing director of the company, and R. Dinesh, executive vice chairman of the company. Good afternoon, gentlemen.
Good afternoon. Good afternoon. Mahalakshmi.
Good afternoon.
All right, I'm going to start off by asking you about A, how do you intend to utilize the proceeds? How are you going to why is the issue resized from a 2000 odd crore IPO earlier that was envisaged to 880 odd crore now? What explains that, and how do you intend to utilize the proceeds?
Okay, so let me first start by saying we are India's largest multinational company in terms of supply chain solutions, and we operate in multiple countries across the globe. We pioneered the concept of 3PL in India, and we boast of Fortune 500 customers, 72 of them at the end of FY23. And we have a very scalable model which has delivered significant results over the last 3 years. We come to the IPO itself. It's a 600 crore fresh shares and about 280 crores secondary. The 600 crores is preceded by the fact that we were able to raise about 417 crores before the IPO. And another 150 crores, which was pre-IPO. So our total equity raise will be including the current because of 1,100 crores. And if you look at our net debt, gross debt, it's at about 1,700 crores. So we intend to pay the or settle the long-term debts with the IPO proceeds, and that will give us significant headroom for us to grow as we move into the next phase of our journey.
So, Ravi, I wanted to first, before we get into anything else, understand from you in this space, what is your sweet spot really? I mean, is it large companies? Is it mid-sized companies? What do you see right now as the sweet spot? And where do you go from here in terms of strategy? Do you go after large companies, or in terms of strategy, what is it now and what is it looking like going forward?
Sure. So let me explain. I think you did touch upon the sweet spot. It is really customers and customer focused, customer centric, and delivering solutions to our customers is really what we are focused on. If you look at our early journey, we acquired companies outside of India to acquire the capabilities which were residing in the Western markets. We acquired a company in 2008 in the UK, which gave us tremendous capability in aftermarkets. We acquired a company in the US in 2012, which gave us great capability in production supply chain. And today, what we are is coming together of all of these capabilities, the knowledge that we have of deploying solutions in multiple countries and multiple verticals, and that combined with the technology platform that we have built is really what our global supply chain platform is all about. And what we have done is successfully been able to add customers on this platform. Just to give you a piece of statistic, we work with Fortune 500 customers, 72 of them, like I mentioned, in FY23. That number was 54 in FY21, 61 in FY22, and 72 in FY23. So it's a scalable platform. It's able to deliver significant benefits, and we use a significant amount of technology, which is homegrown, which gives us the flexibility and the ability to drive efficiency into our customer businesses.
Sure. And how is the competition intensity in your business, and especially in the range that you operate in? Are you competing with larger players, or are you competing with? And I think in the forwarding business there are also a lot of mom and pop family businesses, which is a very unorganized segment. So in the segment that you operate, what is the competition intensity?
So we typically operate at a large customer, mid-sized customers, manufacturing, production, supply chain, consumer durables, energy, utilities. These are the sectors that we work with, and we have a different set of competitors in different segments of our business. In the US, we typically compete with mid-range players, Ryder Corporation, Syncreon. These would be the competition. In India, some parts of the business we compete with the likes of Delivery and Mahindra Logistics. Many parts of the solutioning business, like you rightly said, we compete with the larger players, be it DB Shankar and the like. So it is a varied set of competitive force, and in many ways, you addressed it. It's a very fragmented market, and our opportunity really is to make sure that the customers that we engage with have the propensity to buy more than one capability from us, the ability for us to serve them in multiple countries. These are the things which are delivering the growth that we are seeing over the last 3 years. And just to put it in perspective, in FY20, our revenues were about 6,600 crores, and in FY23, that number is 10,235 crores. All of that being through our organic engine, barring a small acquisition which we made in FY21 of about 171 crores. So that explains the growth and the strategy. I was going to be very customer centric. We will want to expand our footprint in the existing customers and also serve them in multiple geographies that they are participating in. So we call it the C cubed or the 3C strategy: customer, capability, and country.
Sure. One more question about the business. How capital intensive is your business? Because last 3 years of financials that we see is not really a true reflection of the returns in the business because of COVID disruption and so on. On a steady state basis, what kind of return ratios can this business really operate at?
Right. We are an asset-light company, so the capital that we employ is typically to fit out warehouse. We lease warehouses, we lease trucks if in our transportation solutions. So ours is a very Capex, I would say, low intensity. But we have deployed funds in acquiring customers over the course of our journey. We have made acquisition in 2008 and 2012, and then the recent set of acquisitions in 2018-19, when we acquired a pan-Asia global forwarding network. So multiple companies, so that we can build a very strong network to support our customers in support the trade that we see between Asia and the Western markets. So that is really what I would say is where a lot of the capital is going. Our ROC numbers, you rightly pointed out in post-COVID, but we have managed that very effectively. It has grown by almost from 5.5 to 7.6, and that is coming on the back of strong revenue and strong EBITDA growth. So EBITDA grew from about 243 to 683 crores between FY20 and FY23. And on the other side, we have a significant increase in our inventory turns. So it's increased from about 5.5 to about 7.1. And our net working capital has come down tremendously to about 18 working days. So that gives us the opportunity to manage our ROC better, and we benchmark ourselves with the best in the business, and they are in the upper teens, and that's really what we are benchmarking our company against. And I think the levers of revenue growth, EBITDA expansion, and coupled with the ability for us to get better inventory turns and net working capital management is going to drive that capital efficiency.
So you're talking about ROC,
Sorry.
ROC number in mid-teens or ROE number in mid-teens?
ROCE, yeah.
Just to
And
clarify,
how much leverage are you comfortable with?
Sorry, I missed that question.
How much leverage? You said mid-teens ROC. I'm asking how much leverage are you comfortable with? Debt levels.
no. So just to clarify, I think two things. One, I think maybe Ravi mentioned inventory turns. It's actually asset turns. So our asset turn is significantly improved. On the leverage side, I think as he mentioned, the proceeds of the IPO will go down to reduce the long-term debt to zero. So post that, there will be only regular working capital requirements which we may have to fund our growth.
Fair
So
enough.
by when would you be a net debt company? Because currently your debt to EBITDA stands at around 3 times FY23. How much do you expect it to go by in this financial year? Are you expecting to be a net debt free company by the end of this financial year? How do you intend to utilize? How is the subsidiary structure also stacking up in terms of debt? Because this particular proceeds will be used to retire the debt there, right?
Right. So we will continue to have working capital debt, and which is probably par for the course, but we will retire all our long-term debts.
So not
So
intend you do not intend to go debt free anytime soon, for that matter.
See, different way of looking at it is that you are, as I said, debt free from a long term perspective, meaning you don't have regular servicing of debt. You have the regular working capital which you use on a regular basis. I mean, it's not like you need to repay back the working capital on a regular basis.
All right. Also, what kind of revenues can one, excuse me, one can be looking at as compared to that of the listed peers? Because the company has just been profitable after 3 consecutive years of making losses. What kind of profitability can be expected in this financial year? Any kind of growth guidance that you can give us on the top line as well as bottom line front?
unfortunately, I don't know if I can give you a guidance, in the current environment until we finish this process. But let me just say that if you look at it from the last 3 years perspective, the revenue growth is out there for you to see, and that is what I was talking about, the scalability of the model. So when you grow revenue from FY20 to 23, which includes a COVID year in between, from 6,600 to 10,000 to 35 crores, that gives you the efficiency at which we are adding revenue. The margin expansion has also been very good, from 243 crores to 683 crores. So I would say that should give us a good idea about how the strategy is getting executed. And for us, I would say the focus really is, if I let me just give you one more data point that will probably help you in looking at it from a different lens, is if you look at the PAT number in FY23, or just the PBT number in FY23, the interest component that drops from the EBITDA to the PBT, the interest was about 7 crores that we had to pay to service the long-term debt that we have. So that kind of gives you an idea of what the pro forma profitability could be.
And just to clarify, if you look at the past, if the from 2004 till 2021, we have a revenue of about 6,900 crores. I think that coupled with the 21 to 23 number which Ravi mentioned, I think will give you an idea.
Sure. You guys also spoke about a lot of inorganic expansion, for that matter. I'd want to understand plans both on any inorganic growth that the company might have, or for that matter, capex that will be earmarked for the financial year. How do you plan to fund it, if at all?
So the company acquired in the past to gain the capability set that we needed to have. So whether it was aftermarket capability or production support chain capability, or the global forwarding or the Pan Asia network that we built, those were the capabilities that we invested in. I think our capability set is, I would say, near complete. And the last 3 years has really been about saying focus on the organic growth engine of the company, and that's what you've seen play out over the last 3 years. And that would be very much reflective of the strategy of the company as we set out in 20 when we built our plan for FY27.
And on the Capex side, if you look at it, it is mostly what we would have seen in the past would have been replacement Capex.
Sure. So one question on the capex side, gentlemen. You said that you like this company to be an asset light company. It is an asset light company, but if you are outsourcing the entire supply chain for somebody, are you able to really deliver a value proposition to your customer in terms of precision, speed, whatever metrics you look at, with an outsource with a capex light model?
Yeah, I think if you see, our business model, the efficiency and the ability to deliver the precision of work that you spoke about is coming through deployment of technology. And how we deliver the technology, the investment of the technology is something that we bake into the contract. So, for example, if I'm going to build out a warehouse specifically for a customer where I'm going to do some sort of value-added assembly, I would lease the warehouse, and I will have a pass-through cost to the customer. So we manage the capex with a fair amount of transparency with the customer, and see how we get funding from the customer in these because they are dedicated solutions for the customer.
And typically, your approach would be to partner with the service providers, or in some cases, even the technology example. I think you would have people who will partner with us to provide that.
Fair enough. Now, how much of your revenues is really FOB, Ravi, and how much of it is C&F? And what I mean to understand is really, what is your, how does your business really get affected because of dollar billing? How much are you exposed in terms of currency risk?
Okay, let me just say that we earn in the currency, we spend in the currency that we earn. So it is not like an offshore operation. So we earn in dollars and spend in dollars. So the profit and the revenue that you see is actually in that currency. So there's very little of currency risk that we carry, other than any intercompany loans or intracompany loans that we have. Let's say that's if a Singapore unit parks their surplus cash in another unit. That's the only thing which is a non-cash forex gain or loss. So we are. I would say we have no forex hedging risk.
Okay. And looking at your own client portfolio and let's say sensitivity in the past, how susceptible is your growth to global growth? How much is it tied to global growth?
Yeah. So two things that let me talk a little bit about our industry mix itself. If you look at the diversity of our portfolio, about 33% of the business comes from industrial customers, about 23% comes from auto customers, 12% comes from infrastructure, technology and technology infrastructure companies, 12% from consumer. Then you have energy, utilities, healthcare, which constitute about the next 8 to 10%. Then we work with defense departments in different countries. That contributes another 4 to 5%. So it's a fairly diverse portfolio. The second is because the diverse portfolio, even though we saw significant economic headwinds in the Western market last year, our rest of the world business grew by almost 8%, 6%, sorry. And that is coming out of the natural hedge that we have in terms of our business portfolio. So I would say the diversity of our portfolio gives us a fair amount of business risk management. The second is that if you look at our customer engagements, I think we typically sign long-term contracts with a lot of the costs, which are what I would call is a use or pay kind of contracting. So many of our costs are captured in our contracts. So we have a very strong commercial platform within the company, which we are able to manage very well with our large customers.
And the third element is the aftermarket business, which we have. And that also is traditionally resilient, because whenever the production goes down, then the aftermarket tends to pick up.
Sure. And how much support do you get from your own group, the TVS group? What proportion of your business comes from the group? And do you have any understanding from the group in terms of how they can support or drive your growth going forward?
So Mahalakshmi, I wish I can answer that question by saying, I have such an understanding, but actually it's a very competitive space.
But why not? Why not is my question.
I mean,
it
is not the philosophy of the group. And I think from a TVS supply chain perspective, we compete very hard and we need to win all of the businesses. We will be very upset if we lose any business, whether it's from the group or outside. But just to answer your question, the revenues to the group would be in single digits. Within the group, within the related party, I would say it's less than 3.5%.
Tell me, I'm given to understand by some of the analysts that a bulk of the TVS Motors business goes to Mahindra Logistics and not you. Is that correct, first of all? And why is that the case? Are you not competitive enough?
Let me just say that we would like to, we would want to call the TVS Motors that you said is one of our largest customers in India, if not in the globe. So it is a significant portion of our portfolio.
So in short, I think many of the TVS Motors have allowed us to use their logo as part of the RHP.
That's why I'm confidently saying
that we are a very
that
close relationship.
they are one of our key customers, one of the customers that
We showcase.
we showcase.
One last question from me. Much of your business is right now, going through the road route. Now, a lot of action, internally is happening on the railway side. How are you looking at this? Is it a challenge? Is it an opportunity? Because that seems to be our entire, overall national strategy to reduce logistics costs. How are you prepared to look at that as an alternative?
So I think maybe if I can look at it, there are two perspectives to it. One is from the cost of logistics, and that's obviously one of the reasons why there is a focus on the rail. So I think the whether it is the multimodal connectivity program or the Gati Shakti program, as well as quote unquote the push to increase the multimodal activity, especially railway, I think is there from the government side. As Ravi rightly mentioned, for us, it is the building the solutions for the customer. So every customer where there's an opportunity to look at this multi-mode solution, we will continue to do so. But having said that, the big advantage which I think today we have is that the focus of the government on making sure the infrastructure is ready, the last mile infrastructure to have the connectivity between the rail and the road. Once that is there and as it is developing today, I think you will also see us moving forward into that. But unlike a asset payer where we are trying to get control or ownership of a railway or a railway partner, I don't think we need to do that because our solution is based on a customer.
Sure. And this doesn't have any repercussions in terms of your capital intensity, right?
That's exactly why I clarified that very clearly, that we are not looking at getting into, trying to own or control a rail network or a rail, what they call siding, etc. That is not our intent.
Sure. Thank you.
All right. Last two questions that I have for you, gentlemen, in that case is speaking about your revenue mix, and I promise these are going to be a bit less easier ones in that case. 30% revenues domestically and 70% coming in from the international market. Do you see that mix changing anytime soon?
So let me first say that it was a lower number just 3 years ago, and the velocity at which the India market is growing is significantly different than the rest of the world. That should give you a good indication. The second is if you just look at the opportunity, we see opportunities globally and in India, globally from an outsourcing perspective. But India is definitely a very strong play from the manufacturing side, the government's push towards Make in India or the PLI schemes and the China Plus One strategy. All of this, we are seeing early signs of that playing out. And the industry reports put this opportunity, which we call the production supply chain opportunity, to expand from about 6 billion currently to about 18 billion by FY27. So clearly, that's an opportunity for us to participate in India, where the economic activity is significantly different from any other place in the world. By the same token, the e-commerce business is also growing rapidly. It's expected to grow from about 2.5 billion to about 8 billion, and we play in the e-commerce fulfillment side. So I think these factors and the fact that our performance over the last 3 years showed a significantly differential growth in India puts us in a good place to capture that opportunity.
Sure. So can we expect a 50-50 kind of revenue growth coming in from the international and domestic market, say by 2025? If given the kind of schemes that we're talking about, the benefits.
Let me just say there's an intense competition between the various countries. India finished at 3026 crores last year. UK pipped it with 3036. So we'd like to have a very competitive environment internally. But look, every market, we want to go after every opportunity. And that is really what this company is focused upon. We are an India-based multinational company. We are very, I would say, ambitious when it comes to our growth opportunities, whether it's India or outside India. I told you the environmental variables that play currently in India and why we think that there's a differential growth velocity in India. And we are well placed to capture that differential growth that we see in India. So whether it is 30, 70, 35, 65 or 50, 50, we will hopefully be able to share that news as it happens. But it's a very competitive positioning that India has currently, which is pretty encouraging.
All right, let's talk about the company catering to mobile and semiconductor business in that case. How are your plans shaping up for India, specifically when we talk about semiconductor business market out here?
Right. So the good news is I think we already work with the semiconductor business both in India and globally, and we are well positioned. We see definitely significant activity in that space when it comes to assembly of semiconductor-based products. So there are opportunities which I would say very early stage, but we are well placed to do that because both our process and our systems are well in sync to capture that opportunity.
All right, gentlemen, with this, it's a wrap, and thank you so much for taking out the time and speaking to us.
Thank you.
Thank you, Nickey, and thank you, Mahal.
gentlemen.
Thank you so much.